What's going on, guys? Today we've got an excellent episode with Darius Dale. He's the founder and CEO of 42 Macro, my favorite Wall Street advisory firm. They do fantastic research, and as you know, Darius always brings the heat. In this conversation, we talk about why Bitcoin, gold, and stocks, things that used to be called risk assets, maybe actually they're exactly what you need in your portfolio during a time where the dollar and bonds are getting their butts kicked. On top of that, he explains to us exactly what's happening in the treasury market, what's going on with China, Japan, Europe, and much more. Darius always brings information that teaches me something, and this conversation is no different. Here's my latest conversation with Darius Dale. And here we go. Darius, breaking news right as we're about to record this. Elon Musk, the world's richest man, the man who has been slashing government spending, literally living out of a closet essentially in the administration, just tweeted, "I'm sorry, but I just can't stand it anymore. The massive, outrageous, pork-filled congressional spending bill is a disgusting abomination. Shame on those who voted for it. You know you did wrong. You know it." Reaction. What do you think?
I told you, man. I've been trying to tell y'all this train has left the barn. It's left the station. So I'll start by saying, one, thank you for sharing that. Two, thank you for having me. Three, this is exactly what we were warning about last fall when we said Doge is this kabuki theater process that's designed to distract a very gullible American public from trillions of dollars of debt finance tax cuts and not nearly enough expenditure reductions to offset that. So it's great to welcome Elon to this side of the aisle. This the purple side of the aisle. Should have worn my purple tie today. I think Elon, you, me, folks like us, we're doing our best to try to stave off what it could potentially be a real erosion of U.S. borrowing power, borrowing authority in the coming years as a function of our fiscal, our inability to get our fiscal house in order. So thank you, Elon, for calling it out. So
you've got this chart here that says the congressional Republicans' inability to dramatically cut spending. It's basically exactly what Elon is calling out. What is this chart showing us, and what are your takeaways?
Yeah, no, totally. I'm just grabbing this chart from our monthly macro scouting report. We've been showing this chart for years to our clients. Look, what I'm essentially calling out is the fact that something we identified a couple of years ago in the context of our investing during a 420 regime analysis, which is both parties are addicted to fiscal largesse. On one side of the equation, you have the Democrats and their profligate fiscal spending and their aggressive overreach in terms of regulation and spending. And on one side of the aisle, you have folks who just do bad math and don't understand that, hey, if you lose revenues and or if you have a deficit that's 7% and you don't grow nominally 7%, you're going to wind up with a debt to GDP ratio that continues to go higher. So on one side of the aisle, you got people who can't stop spending. On the other side of the aisle, you got people who can't do high school math, and you wind up with, just this, never ending, debt and deficit situation.
So Doge was saying they were going to cut $1 trillion, $2 trillion. There's big numbers out there. I don't know if people ever thought they were actually going to cut $2 trillion, but they thought they're definitely going to cut a good amount. Yeah, you've got a chart here that says, we told you that even if Doge cuts $1 trillion of federal expenditures, it ain't going to fix nothing.
Yeah, this was always my biggest point of contention with Doge. Obviously I support Doge, the concept of Doge, what Doge is trying to do. But to me, again, I always thought it was a very calculated distraction from what actually needs to happen, which is legitimate fiscal austerity, right? If you float in $1 trillion, and so we were in the camp going back to last fall that, hey, Elon's not going to get anywhere near $2 trillion, not $2 trillion of waste in the federal budget. Maybe they'll get up to $1 trillion. We specifically identified $550 billion of things that could cut back then. Obviously, they stopped well shy of that. But we said, hey, let's just give them full credit of the benefit of the doubt. Let's say we float an entire $1 trillion of federal expenditure reduction all the way down to the bottom line. What would that do in debt to deficit to GDP terms? Well, you'd wind up you go from a 7% budget deficit to GDP to a 5% budget deficit to GDP. And again, this exercise does not include any negative ramifications upon the economy via tax receipts. And it also is pro forma prior to the one big ugly bill that is now adding incremental debt to the deficits to the debt. So, this U.S. fiscal situation is a real issue. I mean, you look at the last couple of years, the deficit grew by $250 billion in 2024 after growing $365 billion in 2023. It's probably going to shrink a bit because of tariff revenues in 2025. But in my opinion, that's more of a transitory shock because, again, once you walk into 2026, you're going to start to wind that sucker back up again.
Now, I think I heard a translation in there. I think they call it the one big beautiful bill. You called it the one big ugly bill.
So does Elon. Can a big be beautiful and big in the context of our starting point? Go back to that first chart, Matt. Put the first chart back on the screen. You look at the U.S.'s federal expenditures as a percent of nominal GDP at 24%. We are at like financial crisis type levels of federal expenditures. Go back to the GFC when everybody was unemployed and we're handing out unemployment checks and everybody was on Medicaid and SNAP and everything else. That's the kind of expenditures that we have now. So America clearly voted for the Congressional Republican Party to come in and fix this. Well, now that they're sitting in the driver's seat, they're like, you know what? This pork tastes kind of good. That's for lack of a better word. Yeah.
China, they having a blast right now. They seem to, the world's distracted. Let us make some moves. What are they doing?
Yeah. No, well, look, I tell you what, man, never underestimate your enemy. That's what page 1 of Sun Tzu. Page 2 of Sun Tzu is probably never underestimate the Chinese dynasty because these people are always plotting and scheming. I'm hopeful that the U.S. wins this geopolitical strategic conflict, but as evidenced by our inability to cut federal expenditures from extreme levels to suggest that we're not even playing in the right game, right? Like they're playing Go and or chess, and we're setting up a checkers board, right? In my opinion. So what this chart shows is the imports from various countries, just to track the share of imports and how they've evolved over time. And what we see from China is that U.S. imports from China are now 9% of total imports, and that's 1 month of data from the month of April. If you look at it on a trailing 1 year basis, it's 13%. That 13% is down from a peak of 24% back in 2015. So the share of imports that we get from China continues to decline, which ultimately means the amount of dollars that China needs to reinvest in the treasury market will continue to decline as a share of the total amount of marketable treasury securities, especially in the context of our deficit situation that we can't seem to get under control. So this is a world in which you have one of the main investors in the U.S. treasury market, China being the number 3 economy. I think they own 3 to 4% total of the marketable treasury market. They just will need to reinvest and recycle dollars into the treasury market at a lower and lower frequency going forward.
What about Europe and Japan?
Yeah, it's the same dynamic for different reasons. So with respect to Europe and Japan, they currently have economic incentive to repatriate capital from the treasury bond market. China has incentive to stop investing at the same rate, which is a problem when you have budget deficits that need to constantly be capitalized. We need to capitalize somewhere between 6 to 7% of U.S. GDP's worth budget deficits every year. And so if you have one major investor cohort pulling away, that's China from a strategic decoupling standpoint. And then you have our other two investors, the two big investors. Europe owns, I want to say, somewhere close to 8 or 9% of the marketable treasury market. When you aggregate the Eurozone economies, Japan owns about 4 to 5% total. So, this is a big swath of the U.S. treasury market from a foreign ownership perspective. And with respect to U.S. and with respect to European and Japanese investors, it's no longer economic for them to invest in treasuries, right? If you look at the yield, the spread that the European-based investors get for investing in treasuries, let's say the 10-year nominal treasury yield, once you hedge out the currency risk from their perspective, they're losing 83 basis points relative to their home market. Japan, you're losing 107 basis points relative to your home market. So you would make 2.89% if you're a European-based investor and just investing in the 10-year weighted average European yields. You would make 1.49% if you're a Japanese investor investing in the JGB market. You would actually lose 83 basis points and 107 basis points respectively relative to those numbers. So it doesn't make any economic sense for this pocket of, I guess I would say, friendly investors to continue investing in the treasury market at the same speed, which is a problem because, again, you're talking about the 3 largest sources of external demand for our marketable treasury market, all moving in the wrong direction at the same time. Congressional Republicans are legislating the one big ugly bill.
Let's jump to the U.S. public sector, and they seem to be already consuming a historically large share of the world's capital. It seems like on one hand, it could be good, but maybe not what people think it is. Today's episode is brought to you by my partner Bitwise, the global crypto asset manager. Bitwise has $10 billion in client assets, a team of 100 plus people, and more than 30 crypto products to help investors get whatever access they want. They manage the world's largest crypto index fund and a wide range of crypto ETFs. They also manage private alpha strategies, have SMAs for large investors, and are one of the largest institutional Ethereum staking providers. And oh yeah, they've been in the game since 2017. These guys know the space inside and out. So check out Bitwise. Go to bitwiseinvestments.com and see all they've got to offer. That's bitwiseinvestments.com. There are a million ways to access crypto. Explore how you can access it best with Bitwise. And always, of course, carefully consider the extreme risks associated with crypto. Today's episode is brought to you by Bitcoin IRA. Are you a crypto investor with a retirement account but don't have any crypto in your retirement account? Listen up, this is for you. Bitcoin IRA is revolutionizing the way Americans save for retirement by helping smart investors diversify their savings with access to over 75 cryptocurrencies. With world-class customer service, military-grade encryption, and a vertically integrated licensed trust company, it's no wonder more than 200,000 Americans trust Bitcoin IRA to secure their financial future. Get started. It is quick and easy. It takes just 3 minutes to open an account. Once you're set up, their team of IRA specialists will reach out to guide you through every step of the process. Whether you're transferring an IRA from a legacy bank, rolling over an old 401k, or starting fresh with a new contribution, the Bitcoin IRA team is here to help you get access to real crypto in your retirement account. And here is the best part. As a Pomp podcast listener, you can earn up to $1,000 in rewards when you add funds to your account before tax day. Search for Bitcoin IRA in the App Store or visit bitcoinira.com/pomp to join 200,000 Americans on their journey to upgrade their retirement. That's bitcoinira.com/pomp to upgrade your retirement today. Let's jump to the U.S. public sector, and they seem to be already consuming a historically large share of the world's capital. It seems like on one hand, it could be good, but maybe not what people think it is.
Oh, it's definitely not good. Sorry, let me be very, very clear about this. So again, you have Europe remilitarizing, which is going to, essentially be a capital call for their economy, for the German economy, and for other economies across Europe. You have Japan's monetary policy normalization continuing. You still have persistent above targeted growth in inflation, and above target and above trend growth in inflation in Japan with no end to that in sight. So the DOGE was out overnight, essentially confirming that their QT program is going to extend indefinitely into fiscal 2026, fiscal 2027, which starts in April of next year. And then obviously we talked about with respect to China's strategic decoupling, all these are three major geopolitical forces that essentially represents a negative demand shock for U.S. Treasury debt. And that's a problem in the context of the following two statistics. One, the U.S. already has more public sector debt than it can capitalize with its own internally generated capital. If you look at the U.S.'s debt to liquidity ratio, we're at 114%. That means we have 114% of U.S. public sector debt relative to the amount of U.S. domestic liquidity. If you want to compare that to our peer economies like Europe, it's 61%, Japan is 61%, China's at 31%. So we're nowhere near in the area code of what a healthy debt to liquidity ratio will look like. And moreover, if you look at U.S. public sector debt as a share of global public sector debt, it's now 35%. It was 24% back in there, but essentially 20 years ago. And so it's been this kind of one-way move higher in terms of how much of the world's capital we've been gobbling up. And I'm not calling for an imminent crisis collapse or anything, but again, I think this is all part and parcel to what our long-term conclusion has been on the next slide, which is the risk asset is the Treasury bond market. It's not stocks. It's not gold. It's not Bitcoin. And that's exactly what the market's telling you today from a year-to-date performance perspective. Stocks up 2%, Bitcoin up 13%, gold up 28%. And this is versus the dollar that's down 7% and Treasury bonds that are down 3%. Again, you need to freeze frame that performance spread or those relative performance of those risk assets versus those traditionally defensive assets. And just remember that every time the market is down for the now until we get through the end of this fourth turning poly crisis.
I would keep saying, I don't know for how long now, why would you consider bonds safe if they're guaranteed to lose value? It makes no sense to me. It's crazy to me that people are still running around talking about, I'm going to bonds, I'm going to cash, I'm going like nuts. So you think the safest asset in your portfolio is the thing that's guaranteed to lose value? By the way, other things could go down, but at least you got a shot that they're not going to go down.
Totally.
The bonds and the dollars are guaranteed. There's no shot that they're going up in value over time.
Yeah, well, I wouldn't say no shot because there's obviously a distribution of outcomes, but again, it's a really negatively skewed distribution for those assets, right? That's the problem, right? Like there is a geopolitically driven supply-demand imbalance in the treasury market. We have less demand and more supply, and neither political party here in the United States of America has any real political will to fix it. And so this is why, if we go to the final slide, this is something we continue to pound the table on to our client base and to retail investors all around the world, which is the best way to be exposed to financial market risk, certainly throughout the duration of a forward-turning poly crisis, is via risk assets, because there are very limited levers that the sovereign can pull to get itself out of this mess. There's grow your way out of the mess, there's print your way out of the mess, or there's cut your way out of the mess from a fiscal austerity perspective. We just saw their willingness to do number 3 is very low. So guess what? They're going to try number 2, grow their way out of the mess. When that fails, guess what they're going to do? Print their way out of the mess.
I know exactly what they're going to do.
Exactly.
Here's the crazy thing. You know what I've been saying? This is bad for my country. This is good for my portfolio.
Yeah, 100%.
That is going to be the next decade or so of what we're probably going to face here. Is it's bad for my country, it's good for my portfolio. And the people on the internet understand that better than the people in the institutions. And it seems like the retail investors is just buy every dip, deploy capital, just keep throwing money into the market because the alternative of cash or bonds, not good. I don't know. Institutions, there's plenty of them that are going to make money, right? They're not dumb. They're working hard. But it does seem like more of them are sitting on the sidelines than you would otherwise think, considering what retail's doing.
Yeah, we can observe that in our positioning model. We track 12 or 15 different indicators across, from long-term time with long-term time series, and we can see that none of those indicators was even close to where they were in the at the February highs. I obviously talk to institutional clients. We advise on $25 trillion worth of institutional client AUM. I'm talking to institutional client investors every single day of the week, including Sundays. Some days, to a person, no one is fully invested. It certainly has like they were back at the highs of February. So, we're going to continue to pound the table on our paradigm C thesis, which is, hey, they're going to try to grow their way out and eventually they'll wind up trying to print their way out once that fails. And until then, you just need to stay focused on the 3 asset classes that matter from the perspective of retiring on time and comfortably as a retail investor: stocks, gold, Bitcoin. Your job is to be max long those assets until you get a risk management signal that tells you to raise cash so that you can do the most important thing I think most retail investors should be doing if they want to retire on time and comfortably, which is avoid volatility drag. And that's what this chart shows, is that if you can reasonably, consistently sell somewhere near the top, you're never going to sell the exact top, sell somewhere near the top, ride out a bear market, and buy somewhere near the bottom. You don't have to buy, you're never going to buy the exact bottom unless it's pure luck. And buy somewhere near the bottom, even it could be 10, 20% off the bottom. Is if you truncate, if you take out that negative alpha, that negative beta from your portfolio, and you do that consistently, what you're going to wind up happening is you're going to compound your portfolio from higher levels of net asset value, and you're going to see the money that you have in your account widen relative to everyone else who's not doing that. So this is why we continue to pound the table on our institutional risk management frameworks that we feature in our KISS portfolio construction process, which is stocks, gold, Bitcoin, no bonds.
Hey, you ain't gonna convince me. I've been telling people that Bitcoin is the new bond, right? If you think about it from that perspective, sure. People are like, oh, but I don't get my my interest payment.
Who cares?
Well, you're getting a negative interest payment because you're losing money on the on the actual principal. Like, what are you doing?
We're going to, Pomp, you and I are going to revolutionize the way a lot of investors approach financial market risk. Our clients tend to skew older and richer because they tend to be more focused on risk management. But again, at some point, the people that you and I are talking to will be 10 years older and 10 years richer. And they're going to start to care about risk management as well. So I'm glad that you've been pounding the table on Bitcoin and helping folks like me get comfortable with the asset class so we can turn around and help other people get comfortable with the asset class. Because to me, it's one of the only ways out.
Could not agree more. Where can we send people to find more about 42 Macro?
I appreciate you, brother. Thank you so much for having me. 42macro.com. I'm on Twitter, 42macrodale. Come collect this free alpha, and the alpha only gets bigger and better when you get inside of our paywall. So we appreciate you.
Free alpha on the internet, on social.
Is that not true?
That is 100% true. But say it again. That was such a good line. I need the fire one more time. Say it again.
Come collect this free alpha, and the alpha only gets bigger and better when you get inside of our paywall. You go ask our clients. Don't you? I speak truth. If I was terrible at my job, I would tell you I was average at my job. I'm not average at my job. Appreciate you, brother.
We're going to do this again soon. Thank you so much.
Thanks, fam.